In this lesson, we're going to go back to some basic market structures. Q points are confirmed swings, and they are my proprietary concept. Q points came about from my need to explain to a computer through code systematically what is a swing extreme. Now, a lot of traders get caught up in complicated strategies, looking at their EMAs and RSIs and MACD divergences and all the other million lagging indicators that promise a lot, but in the end, a lot of traders tend to neglect looking just at the basic market structure. What does that mean? It means when you're looking at swings and how they were formed, can you identify where that move came from? That is what constitutes your swing extreme, okay? So the question is, how do you determine when a swing is actually done? Market will kind of weave up and down, creating smaller waves, but there is such a time when the price has made an obvious high and an obvious low. But the question remains, when is it safe to call it a confirmed swing? And that's what this lesson is all about. It's a concept that I came up with, and it's called Q points, which stands for quartile points. Over a period of 12 months, I worked with a software architect and a small team of developers to create algorithms based on some of my strategies. So I had to explain this concept of swing extremes in a way that a computer would understand it, because I could intuitively see where it is, but at that point I had no way of systematically teaching others how to do it. Although I did mentor other traders, they also had the human eyes, so they were obviously able to find their swing extremes, and most were pretty good at that, just using their eyes. They didn't need anything else. But try to explain that to a computer and it just makes no sense. The algorithm needed a systematic way to locate the swing extremes just like a human eye would see them. So after banging our heads over that, I think it was like a good 5 months, it was frustrating beyond belief. And we finally had a breakthrough, but I had to reanalyze how I look at swings as well. So I noticed that I wasn't always buying and selling exactly at the marked zones. In fact, I sometimes used market profile to get in on trades that were kind of in and around the extremes and supply and demand zones. A lot of the times, price would be reacting to maybe a much larger time frame. So one day I was listening to Rand Squawk service, and they were kind of banging on about Q1 and quarterly earnings and Q3. And I suddenly had this an idea that maybe I can use the quartiles to see if that's the stuff that's reacting to my zone. So I went back through all of my trades, and I realized that I was indeed using these quartile points to find my trade locations. So what are they? They are a systematic way of finding trade locations with the highest reward and lowest risk. And quartile points are really nothing more than a swing from A to B divided into 4 equal pieces. But there is more to it than that. Okay, so here's a silver chart with my my hacked fib tool on it. It's just like a normal fib tool. It's how I used to do things before Blatek. So here I'm only marking the high and the low. The question was, when does this swing become a confirmed swing and not just a downward move that might create a lower low and then another low and then another low? Well, we came to a conclusion that the best way to determine a confirmed swing is when the price crosses back the other way more than 50% of the move. So what does that mean? You're using the 50% crossover to trigger the top quartile and the lower quartile. Okay? You're not trading the 50% mark. Up until this happens, up until the 50% retrace happens, there are no Q points. They don't exist. So once the price retraces over 50% of the move, you then and only then have the top and bottom Q points, which then become your zones of interest, your ZOEs. So let's expand this chart more to see how the price is going to react to some of these, right? So you see that I'm now marking the old way my Q point high and Q point low, as you can see here, okay? Now let's expand this chart and add some supply and demand zones to see how the price reacts to Q points and to supply demand areas. So on this chart, I'm marking a supply zone. This is a supply deep inside the top Q point, right? It's quite high into it. And then I also have this demand on the bottom. Now, supply and demand here are both reasonably strong, okay? And more on the strength of zones in upcoming lessons. But look at this top Q point and how the price kind of pops into it, then begins to consolidate. Everything gets a bit choppy and then goes back to the Q point, kind of meanders back into it. And then suddenly you have this massive rejection that rejects the Q point and closes vastly outside of it, bringing the price almost instantly down to the Q low. And this happens all the time. You know, it's not just like, oh, I pulled one chart out. Now, Q points serve two purposes. First one is to avoid trading the middles of swings. As one of the traders said to me, yeah, got it, don't diddle in the middle. I get a lot of supply and demand traders coming from all over the place, from different, trading providers, educational providers and such. They even, some of them come across my old Forex Factory thread. And then usually they complain that supply and demand zones don't work. But one glance at their charts and I see that they're trading middles of swings like constantly. Now let me make something perfectly clear, which is a question that kind of keeps cropping up. Traders at Blatek and Market Stalkers, we use the daily Q points for swing entries. The rule of not trading the middles, it really only means not trading outside of the daily Q points. It's entirely possible to have a look at the weekly chart that is in the middle of nowhere, and or even a monthly chart. You can have this massive time frame. So you don't have to be at the swing extreme. You don't have to be at a weekly or a monthly Q point to trade. But what you do need to have on these large time frames is to at least have some kind of engulfing pattern or a supply and demand area that might be reactive. And that's where you would then drop down to your daily chart, which should be either your main trade entry location at the very least, or a 4-hour chart as well. But the daily chart really needs to have a Q low or a Q high for your trade entry. Now, of course, if you come across an area of a weekly Q point or a monthly Q point, because it's such a large time frame, don't ignore it, because that time frame will then take precedence. In practical terms, this will mean that when you've arrived at a large time frame Q point, and you notice that the price action has either slowed down or even showed you a price action rejection already, if on the daily chart you then run into an opposing Q point, don't trade it. So to summarize quickly, you can be in the middle of a swing on the weekly and monthly charts as long as your daily chart is finally reaching a daily Q low or Q